The May 15th session opened with textbook momentum. Early institutional buying pushed indices higher, but as the session aged, the market sharply reversed course. Aggressive late-session profit booking materialized out of nowhere, dragging the broad market from a position of strength deep into the red. The intraday numbers reflect a brutal swing. The Sensex plummeted from a daily high of 75,870 to close down 160 points. The Nifty 50 mirrored this rejection, falling from nearly 23,840 to close at 23,643. By the closing bell, this selling pressure had erased exactly 1.67 lakh crore rupees in total market capitalization across BSE-listed companies. This represents a substantial extraction of liquidity in a single afternoon. The scale of this capital destruction suggests a shift in market sentiment that goes beyond typical end-of-week profit-taking. Right now, domestic index health is hostage to external economic shocks. To accurately project the upcoming session, we have to isolate two specific datasets: global energy and currency metrics, and the underlying domestic chart indicators. Domestic support and resistance levels are mathematically irrelevant until we measure the external catalysts actively driving the sell-off. The first external shock hitting the markets is the energy sector. Brent crude futures broke out by 3.2%. This currency drop is directly correlated to surging global bond yields and aggressive restrictive commentary from U.S. monetary policymakers. When you combine oil breaking $109 with a falling currency, you generate a twin deficit panic. Institutional capital is effectively forced to trim its exposure to Indian equities to mitigate risk. Compounding the economic data is a sudden injection of geopolitical risk originating in the Middle East. Iranian personnel allegedly seized a vessel operating off the coast of the United Arab Emirates, threatening a vital global trade corridor. Diplomatic channels stalled immediately after Washington rejected a 14-point peace proposal drafted by Iran. Simultaneously, high-level talks between the U.S. and China ended without a breakthrough, locking in the existing macroeconomic friction between the two largest economies. These overlapping tensions have effectively neutralized the recent global AI-driven tech rally. Without that external momentum, Indian markets are now vulnerable to local technical breakdowns. This chart shows the daily price action of the Nifty 50. Looking at the data from LKP Securities, we can see exactly how this macro fear is translating into institutional selling. Notice the continuous series of lower tops. This pattern confirms that sellers are stepping in at lower and lower price points, creating a definitive bearish setup. On the daily time frame, the index is facing intense overhead resistance from the 20-day moving average, capping short-term momentum. Zooming out to the weekly time frame, the 50-day moving average is acting as a secondary structural ceiling. Underneath the price action, the relative strength index has executed a bearish crossover and continues to slope downward, confirming momentum decay. Add to this a surge in volatility, with the India VIX rising 9% from its intraday lows. The chart is mathematically rejecting upward momentum. The technical indicators are aligning with the fear in the global macro data. Based on analysis from SBI Securities, we can map the specific battleground zones. The immediate supply zone lies between 23,800 and 23,850. Even if short covering triggers a relief rally, heavy distribution pressure extends all the way up to the 24,000 mark. On the downside, the immediate line of defense is 23,600. However, analysts view this as a zone of temporary consolidation. The critical pivot for the entire market structure sits lower, forming a tight floor between 23,500 and 23,450. If selling pressure breaks that 23,500 level and sustains it, the mathematics expose the index to a rapid slide toward 23,300 and eventually down to 23,150. If the 23,500 level fails to hold, the index loses the primary technical floor that has historically prevented deeper multi-week corrections. This scale represents the current market tension. On one side, strong Q4 corporate earnings and attractive valuations are trying to act as an anchor. On the other side, rising bond yields, $109 crude, and a falling rupee are dragging the system down. Despite robust corporate performance, the velocity of the systemic liquidity drain is currently overpowering the market. GeoJet analysts point out that institutional strategy is adapting. The market is now reliant on potential government fiscal or monetary interventions to stabilize the balance of payments. The overarching narrative driving the market has definitively pivoted away from optimistic corporate growth, shifting heavily toward macroeconomic defense. Moving into the next session, traders should anticipate a volatile, drawn-out consolidation phase. A rapid V-shaped recovery is unlikely given current headwinds. Before executing any intraday index trades, actively monitor Brent crude prices and the USD to INR exchange rate. If those metrics fail to cool off, domestic indices will remain suppressed. In a market defined by geopolitical risk and currency depreciation, strict adherence to the 23,500 support level is the only viable strategy for risk management.